Many traders discover inversion fair value gaps and assume every inversion will lead to a clean reversal. The problem is that most of them appear in the middle of random price action, without the context needed to make them reliable. When traders take every inversion they see, price can easily ignore the level and trap them in the wrong direction. Welcome to the ComLucro channel. In this video, you are going to learn how to trade inversion fair value gaps using proper context, including liquidity grabs and higher time frame key levels. By the end of this session, you will understand when an inversion FVG becomes a high probability setup and when it is better to stay out of the trade. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before we define what an inversion fair value gap is, we first need to review what a fair value gap is. Let us begin with the core idea. A bullish fair value gap is the price space formed between the high of the first candle and the low of the third candle within a 3-candle sequence. In the same way, a bearish fair value gap is the space between the low of the first candle and the high of the third candle. The color of the candles is irrelevant, and their shape or size does not change the concept. The psychology behind a bullish fair value gap reflects a buy-side imbalance, where buying pressure clearly dominates selling pressure and creates that inefficiency in price. When marking this manually on your chart, traders often highlight this area as a potential demand zone to look for long opportunities. The same logic applies in the bearish case. When price revisits a bearish fair value gap, traders anticipate a reaction and manually treat that area as a supply zone. So what exactly is an inversion fair value gap? An inversion, also called an inversed FVG, occurs when a previously identified fair value gap fails and price invalidates it. For instance, imagine a bullish imbalance that creates a clear gap on your chart. As price retraces back into that area, the expectation is a continuation to the upside. However, if the following candles close decisively below the gap, fully violating it, the market has disrespected that level, and this failure forms the inversion. Now, let us understand the psychology behind the inversion FVG. The appearance of an inversion fair value gap is often an early indication that momentum is shifting. It reveals that the side responsible for creating the original imbalance has lost control. This change in strength can signal a potential reversal in direction. From basic price action principles, we know that after a breakout, previous support can become resistance, and previous resistance can become support. The same principle applies to fair value gaps. When a bullish fair value gap that once acted as a demand area is broken to the downside, it transforms into a supply zone. As a result, we can anticipate a possible rejection from that inversion FVG toward the downside. So how can we determine whether a fair value gap will hold or become an inversion? When trading fair value gaps, what we want to observe is price returning to the zone and respecting its midpoint, which often leads to a continuation higher. If instead price trades into the area and clearly violates that midpoint, we can anticipate further downside, with candles closing below the fair value gap and forming an inversion. To mark the midpoint manually, simply measure the range of the gap from its low to its high and identify the 50% level directly on your chart without relying on any indicator. Now, there is an important detail to understand. Fair value gaps are considered one-time use. Once price has reacted to an FVG and the market has already delivered a move from it, we no longer treat that same gap as a fresh trading opportunity. If price later breaks through it, we do not classify that as an inversion FVG. When searching for a true inversion, we want to see a sharp shift in momentum that fully disrespects the gap from the start. This brings us to the question, fair value gap or inversion fair value gap? Which one is superior? In reality, neither is better than the other. Both can be highly profitable when applied under the right conditions. They represent different types of setups, each with its own advantages and limitations. In general terms, the inversion behaves more like a reversal strategy, while the standard FVG aligns with trend continuation. For that reason, inversion setups often offer greater risk to reward potential. That said, fair value gaps appear more frequently on the chart, whereas identifying a clean inversion FVG that meets all your criteria can be more challenging. In addition, once you identify a valid inversion fair value gap, you typically do not require extra confirmation to execute the trade. However, identifying the inversion itself is only the first step. Understanding how and where to apply it is what truly determines whether the setup becomes a high probability opportunity or just another failed signal. Before we go deeper, we need to clarify something. Trading inversion FVGs in isolation is a mistake, and the reason is simple. An inversion FVG represents a potential reversal signal, but when it appears in the middle of random price action, it lacks strength and context. In those cases, price can easily ignore the inversion and trap traders looking for an early entry. If you take every inversion you spot without additional confluence, you will likely face unnecessary losses. That is why we combine inversion fair value gaps with two key concepts. Instead of treating the inversion as an isolated signal, we place it inside a simple framework that connects liquidity events with higher time frame context. When these elements align with the inversion, the probability of a meaningful reversal increases significantly. In practice, this framework produces two main scenarios where inversion fair value gaps tend to work best. The first scenario is when the inversion forms after a liquidity grab. This means price has already swept buy-side liquidity, triggering stop losses and trapping traders positioned in the wrong direction. After liquidity is taken, price often has a greater probability of moving towards sell-side liquidity on the opposite side. When an inversion FVG appears immediately after that sweep, it confirms the momentum shift and signals a potential reversal. The combination of a liquidity grab followed by an inversion is a very powerful setup. The second scenario occurs when an inversion forms at a higher time frame key level. This tells us the formation is not random, but rather happening at a location where meaningful reactions are more likely. Higher time frame levels attract the attention of larger market participants. So when price reaches one of these zones and creates an inversion, it suggests that significant orders may be entering the market. In this context, the inversion serves as confirmation that the higher time frame level is being respected. Instead of guessing whether the level will hold, you now have clear price action evidence of rejection and a strong reversal signal. That confluence makes it a high-quality trading opportunity. On the Euro-Dollar 1-hour chart, we begin by focusing on several key elements, including liquidity grabs, fair value gaps, and inversion formations. These concepts help us understand how price reacts around imbalances and liquidity zones. To make them clear on the chart, we will mark these structures manually, identifying the liquidity levels and fair value gaps directly on the price action. At this stage, we can observe that price has already taken the liquidity resting below these lows and then quickly closed back above the previous range. Above the current price, however, we can also identify a fair value gap that reflects bearish momentum. Under normal circumstances, we would expect price to reject that FVG and continue pushing lower. In this particular case, though, the liquidity grab below the lows suggests that the market may actually be preparing for a reversal. Because of that, let us move the chart forward and observe how price reacts next. From the continuation of the price action, we can clearly see that the market has ignored the fair value gap and instead closed above it. This behavior transforms the original gap into an inversion fair value gap. With that structure in place, we can now anticipate a rejection from this inversion zone and a potential push upward from that level. Looking at another example, we can identify a fair value gap forming on the 1-hour chart, which initially signals bullish momentum in the market. Shortly afterward, however, price suddenly drops and invalidates that imbalance, effectively turning it into an inversion. The important question now becomes how we determine whether this shift in momentum is meaningful or simply a random market fluctuation. To understand that better, let's zoom out to a higher time frame and evaluate the broader market context. On the daily chart, we can now mark the order blocks manually to highlight the most important supply and demand zones. Once those areas are identified, it becomes clear that price has just tapped into a bearish order block. Even a relatively small reaction to a higher time frame key level can become a significant turning point when viewed on lower time frames. With an inversion fair value gap forming directly inside this higher time frame zone, we can interpret this confluence as a strong signal of a potential trend reversal, or at least a meaningful corrective move. Situations like this allow traders to plan entries with a higher probability framework. To summarize the idea briefly, the key takeaway is that combining lower time frame signals with higher time frame market structure produces a far more reliable trading signal than analyzing a single time frame in isolation. Now, let us look at the USD JPY pair on the 1-hour chart. In this case, we can clearly see a liquidity grab forming below these equal lows. At the same time, there is also a clear inversion fair value gap structure present on the chart. Based on this information, we can anticipate that price may reject this zone and push higher if a pullback occurs. When we move to the 5-minute chart of the same pair, another structure becomes visible. Here we have a fair value gap that the market has completely disrespected, turning it into an inversion formation. In addition, we can also observe a form of liquidity grab above these upper wicks. Before looking for a potential trade setup, however, it is always important to zoom back out to the 1-hour chart so we can evaluate the broader context and confirm the bigger picture. After zooming out, the situation becomes much clearer. Price has just tapped into a higher time frame supply area, which represents an important key level in the market. Levels like this often have the ability to reject price strongly. Even a relatively small reaction at this zone can generate a valuable trading opportunity when we are analyzing entries on the 5-minute chart. With that context established, there are a few additional notes worth mentioning about inversion fair value gaps. In some situations, the breakout that creates the inversion also coincides with the formation of another fair value gap. This phenomenon is often referred to as a change in the state of delivery, which signals a sudden and decisive shift in market momentum. When this occurs near the end of a trend, it frequently precedes a reversal. Finally, when the area of a fair value gap overlaps with an inversion zone, the confluence between these two structures can create a high probability trading opportunity for a short position. In practice, the real edge does not come from the inversion itself, but from the context surrounding it. When an inversion fair value gap appears after a liquidity grab or inside a higher time frame T level, the setup gains much stronger meaning. By combining liquidity, market structure, and multi-time frame analysis, traders can filter out weak signals and focus only on the highest probability opportunities. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here